Hello there and welcome to our reading on non-current long-term liabilities. So when we say non-current liabilities, typically we're talking about a liability that falls due for payment in over 12 months' time. Okay, so let's have a look at our first learning outcome. What we're really going to be looking at in this reading is we're going to be looking at bond accounting, we're going to be looking at some lease accounting, and we'll also tie it up with a bit of pension accounting as well. So our first learning outcome asks us to determine the initial and subsequent recognition and measurement of bonds. So let's start with a bit of terminology to make sure we're okay. So par value of a bond. The par value, sometimes referred to as the face value of the bond. And this is the amount the investor will get back at maturity, regardless of whatever they've paid to purchase the bond. Coupon rate, of course, is the percentage of par value that will be paid in by way of a coupon. So normally quoted as a percentage, it's quoted as an annual percentage, even though most bonds typically pay semi-annually. Now our initial liability, this is going to be the issue price of the bond. In other words, the present value of the bond's cash flows that it's going to generate over its life, discounted at the market rate in existence at the date of issuance. Our effective interest rate is going to be an internal rate of return. It's simply the discount rate that equates the present value of the future cash flows with the issue price. So essentially it's going to be the market rate at the time of issuance. And our interest expense is going to be the book value. This is the opening value of the liability times the effective interest rate each year. Now, it's important to state at this point, the interest expense that we see in the accounts is not necessarily going to equal the coupon. It could do if the bond was issued at par, but it's unlikely that the bond was issued at par, so we're going to find that interest expense and coupon rates will differ somewhat. Okay, let's have a look at the balance sheet. When we initially issue the bond, we're going to create a liability equal to the proceeds we receive when we issue the bond. Now actually, it's proceeds we receive when we issue the bond, or proceeds less any issuance costs. But again, I don't think we need to worry about that too much right now. So we're going to create a liability equal to the cash flows that we receive in when we issue the bond. In the income statement, our interest expense each period is going to be the opening liability value, so the opening liability for the debt instrument times the market rate at the time of issuance. Now this is a key point. Our effective interest rate, the market rate at the time of issuance. Now, of course, in the market, as bond prices fluctuate, yields, in other words, market rates, are going to change. Irrelevant to us. All we're interested in is the market rate at the time that bond was issued. Now, in the cash flow statement, CFO is going to be affected by the coupon paid out, the cash element paid out. And remember, we've already stated that coupon and interest expense are unlikely to be the same thing. Cash flow from financing, well, that of course is going to increase by the proceeds that we raise when we issue the bond, and of course at maturity of that bond it's going to decrease by the principal payment, the face value that is essentially paid out. So let's start off with the most simple situation. Here we've got a bond being issued at par value. In other words, there is no discount or principal on this bond. So the initial liability is simply going to be par value. That's equal to the cash flow that we received when we issued the bond. Now, the idea with bond accounting is we take our initial liability and we adjust it to par over the bond's life. But hey, here we're starting with a bond liability that is already equal to par. So there's no adjustments to be made. Therefore, our bond liability is going to remain at face value over the bond's term. There's no adjustment to make. There's no amortization. Now this phrase amortization is going to apply to bonds that we issue at either discounts or premiums. And it refers to spreading that discount or premium over the life of the bond. Now here, because the bond was issued at par, there is no discount or premium to amortise. So the liability value will just stay at par value over the life of the bond. Now of course, at bond maturity, the liability is there at face value, we pay out face value, so we de-recognise the bond and we show no gain or loss. In the income statement, the interest expense is the opening liability value times the market rate at issuance. Now in this situation, of course, the market rate at issuance will be equal to the coupon. Why? Well, because this bond was trading at par when the bond was issued. So the interest expense opening liability times market rate at issue, par value times market rate at issue, or if you like, par value times coupon rate, we're going to find that the interest expense does equal the coupon. Okay, now again, here's that second point being made. Since the market rate and the coupon rate are the same, the expense is equal to the coupon payment. So I want you to take this away, be very clear about this. In this situation, when the bond is issued at par value, the interest expense and the coupon on the bond are the same thing, but only when that bond is issued at par value. Okay, well let's start looking at bonds that are issued at a discount. Now of course, here when the bond is issued, the market rate, the yield if you like in the marketplace for bonds with that risk, is greater than the coupon rate. In other words, the return that the investor gets from the coupon is insufficient to satisfy their required return, therefore the bond will trade at a discount. Now, in our balance sheet of course, we'll initially record the liability equal to the issue price. This time, of course, it's at a discount to the face value. In other words, it's going to be below par value. Now, the significance is we're going to amortize this discount. Now, when we say we're going to amortize this discount, we're going to treat this discount as interest, and it's going to do two things. Number one, the interest expense is going to be bigger than the coupon. In fact, we're going to find that the interest expense is the coupon plus the amortized discount. And number two, our liability value is going to increase over the life of the bond. Now notice we're mentioning that in our second bullet point here. The liability is going to increase over time as the discount is amortized. Now the idea is what we're going to do is increase the liability's value so that at maturity of the bond, the liability's value is face value or par value. Okay, so we're starting off at a discount, that liability is climbing over the life of the bond and ending up at par value or face value. That way, when the bond is finally retired at maturity, there's no gain or loss. We pay out face value, the liability is face value, so we de-recognise the liability, no gain, no loss. Okay, now again, notice it also says, the third bullet point, the book value at any point in time is the present value of the remaining cash flows discounted back at our original yield on the bond. Fluctuating changes in yield, of course, have an impact on the market value of the bond. It's very important that we realise here that we only see the market value of the bond recorded once, and that's at issuance. Subsequent changes in yields, whilst they affect the market price in the marketplace, they do not affect the value in the accounts. In other words, the balance sheet liability and market value are two very different things. Okay, the face amount, including the discount, is repaid at maturity. In other words, our liability will have climbed so that it's equal to face value at maturity. In the income statement, as we mentioned, we're going to take book value, which of course is our opening liability. Now, the significance is, of course, each year the opening liability, whilst it's increasing over time, the opening liability is below par value. So we're taking the opening liability times the market rate to get our interest expense. Now, essentially what that means is our interest expense is going to be made up of two components. It's going to be made up of the coupon, the actual cash payment, but also the amortized discount. And don't worry, we're going to see the mechanics behind this in just a second. Now, the interest expense is going to increase over time. Why? Because our opening liability each year is going to increase. Remember, the idea here is that liability value is slowly going to migrate towards par value over time. So as the liability gets bigger, then of course interest expense gets bigger, because our interest expense is opening liability times the original market interest rate. Now, bonds issued at a premium, this is really just going to be the flip side of a bond issued at a discount. So we issue the bond at a premium, which means, of course, the price at which it's issued is greater than face value. So initially the liability starts off greater than face value, but now the process of amortization is going to mean that liability value is going to decline over time down to face value. So initially we record the liability at the proceeds we receive when we issue the bond, which, as we said, because the bond is at a premium, because the coupon rate is greater than the investor's required return at the time of issuance, so we're going to record it at a premium, and then we're going to reduce that liability down over time to face value. So here's that key point that you need to take away. The liability is going to decrease down over time as we amortize the premium. Again, the book value of the liability at any point is the present value of any remaining cash flows discounted at the original yield when that bond was issued, the original effective interest rate or market rate when the bond was issued. Now, of course, at maturity, we're going to pay out the face value, and of course the liability will have declined down to this face value, meaning there's no gain or loss in the income statement at maturity when we retire the bond. Income statement, here our interest expense each period is going to be the book value, opening liability value, times the market rate at the time of issuance. Now, what we're going to find essentially here is our interest expense is going to be equal to the coupon minus the amortization of the premium. So when we issued a bond at a discount, the amortization of the discount is going to increase the interest expense, but when we issue a bond at a premium, the amortization of the premium is going to decrease the interest expense. It means the interest expense will be lower than the coupon. But again, we're going to see the mechanics of this via some examples in just a while. Now, of course, this time the interest expense is going to decrease over time, because the liability value, our book value, remember, over time is going to decrease as we amortize that premium. Now, two methods of amortizing premiums or discounts: the effective interest method. And notice our LOS is determined, so we've got to be able to actually potentially produce the numbers behind this. So we've got the effective interest rate method and the straight line method. Now again, effective interest rate method can be used by GAAP, but has to be used by IFRS. So notice required under IFRS, preferred under US GAAP. But US GAAP does have an alternative called straight line amortization, which is far, far more straightforward. Now, let's take our effective interest rate method first. So the interest expense is the yield on the bond when it is first issued, the effective interest rate, times the opening balance sheet liability, as we've said before. And the difference between the coupon and the interest expense is the amortization of the discount or the premium. So essentially what we're going to find is the amortization is going to change from period to period dependent on the beginning balance sheet liability. As that changes, then essentially that's going to change the amount of amortization. Straight line amortization, and we can see that that is permitted under US GAAP, is going to be far more straightforward. All we're going to do is look at the initial discount to par value if the bond's issued at a discount, or premium to par value if the bond's issued at a premium, and simply spread it over the number of years remaining till maturity. Now what that means is our amortization of discount or premium will be constant every year over the bond's life. Okay, so let's get into the mechanics of actually how these numbers essentially work. So let's have a look at a bond issued at a discount. We've got Leeds Corporation here, issued a 3-year bond, $1,000 face value bond, so that's its par value, its face value, and it's got an annual coupon rate at 10%. Now when they issued it, the proceeds they received were $951.96. So this bond has been issued at a discount. Now of course when the bond is issued at a discount, that tells us that the coupon is below the effective rate. Now we can then see that the market interest rate has been given here at 12%. So look, the yield when the bond was issued was 12%, the investor's required return was 12%, but the coupon was only 10%, which of course is why this bond initially traded at a discount. So the bond is issued, up goes our cash by 951.96, and of course we record our initial liability, there it is, 951.96. Okay, so that's the initial liability at the start of year one. We then work out our interest expense. And our interest expense is going to be the opening liability, so 951.96, times the effective interest rate, which is our market interest rate when the bond was issued in this case, so times 12%, and that gives us 114.24 with a little bit of rounding up to the nearest cent. So there's our interest expense, 114.24, and that of course is what is going to be apparent when we look at the income statement. So that's what's hitting our income statement. Now we then compare that to the coupon paid. Now it's a 10% bond, so 10% of $1,000, 10% of face value means the coupon is $100. Now of course the coupon paid we're going to see passing through cash flow from operations certainly under US GAAP. And the difference between our interest expense and the coupon paid is the amortization, essentially. So notice 114.24 is the interest expense, 100 is the coupon, and that leaves us with amortization of 14.24. Well, actually, in terms of double entry, this amortization has done two things. It's made the interest bigger than the coupon by $14.24. The other side of the double entry is our liability is going to rise by this amount. So our liability at the start of year two is our 951.96 plus our 14.24. So our liability 966.20. So we've just added that amortized discount to it. The interest expense in year two, 12% of 966.20. That gives us $115.94. Compare that to the coupon of 100, and therefore the amortization is $15.94. So at the end of year two, beginning of year three, our liability increases by a further $15.94. So 966.20 plus $15.94, and that gives us our 982.14. Interest expense for year three, opening liability 982.14 times our effective rate at the time of issuance, 12%, giving us 117.86. Compare that to the coupon paid 100, so our amortization for year three, 17.86. Now again, this amortization is therefore added to the liability, so 982.14 plus 17.86, and therefore at the end of year three, just before the bond redeems, there our liability is sitting at 1,000. Again, in terms of calculating the amortization, you should be aware that your calculator, especially the BA2 Plus, can calculate the amortization of premiums and discounts. You enter the bond's details as per normal, and in this case, let's imagine it's an annual bond. Well, it is an annual coupon bond, it tells us in the question. So N is 3, future value 1,000, coupon essentially here $100, present value 951.96, and of course our IY 12%. You can compute present value if you want. Then you can go into amortization mode, which you'll find above the present value button. Again, details of how to use the amortization mode on the BA2 Plus is included in the calculator tutorial on the Swayzer portal. Good, let's have a look at the straight line approach. Now the straight line approach is really more simplistic. What it's going to do is just look at the total discount. So $1,000, the par value of the bond, minus 951.96, the proceeds received when the bond is issued. So the total discount that we've got to par is $48.04. We then say, okay, it's a 3-year bond, so let's divide that total discount by 3, and we get 16.01, again rounding to the nearest cent, as our annual amortization. So notice we're going to charge 16.01 each year, and you can see that we actually do that down here. Okay, the 1602 in year 3 is simply caused by our rounding differences, essentially. Okay, so let's have a look at this approach then. Opening liability 951.96. Now we've got to be careful this time. Calculating the interest expense is not going to be so simple. We can't take opening liability times the market interest rate. Instead, we're going to have to manually calculate the interest expense. But remember, it is simply coupon plus the amortized discount. So notice therefore that our coupon is $100 each period, so the interest expense $116.01. We're just adding that amortized discount each period. Now again, compare that to the effective method that we used on the previous slide. On the previous slide, we saw as the opening liability got bigger, the interest expense got bigger each year, even though, of course, the coupon payment was the same. In other words, the amortization of the discount got bigger and bigger and bigger each year. Here, giving us a bigger and bigger interest expense, whereas here, our interest expense is constant each and every year under the straight line approach. Remember, only allowed under US GAAP, of course. Now let's have a look at a zero coupon bond. What this idea of amortizing discounts means is even a bond with no coupon at all does have an impact on your interest expense. So here we are, we've got a 3-year zero coupon bond, par value $1,000, and it's been issued and the proceeds received of $711.78. And that again is using a market rate at the time of issuance of 12%. Now again, we're going to calculate the interest expense the same way as we've been doing before. In other words, opening liability each period times our effective interest rate. So let's do it for year 1. Opening liability, proceeds we received. Remember, up goes cash by $711.78, and we record a counterbalancing liability. So up goes assets, up goes liabilities. Now, of course, therefore, we then take our liability, $711.78, times our effective rate of 12%, and that gives us an interest expense of $85.41. Now, compare that to the coupon paid. Well, hey, this is a zero coupon bond. There is no coupon paid on this. So the coupon is 0. So notice, therefore, what's happening in our income statement and what's happening in our cash flow statement are quite different. In the cash flow statement, you're seeing no impact at all because no coupon is paid. But when we look at the income statement of the company, we are seeing an effect on the interest expense. Now, of course, what that means is the entire interest expense each year is made up of amortized discount. So the full interest expense is amortization here. Okay, so that means that 85.41 is going to be added to the liability. So liability at the end of the first year, beginning of the second year, 711.78 plus the 85.41, giving us 797.19. Interest expense in year 2, 12% of 797.19, giving us 95.66. Full element, of course, being amortization of our discount there. So 95.66 being the amortized discount. Add the 95.66 to your opening liability of 797.19, and we've got the liability at the end of year 2, beginning year 3, 892.85. 12% of that gives us our interest expense in year 3, 107.14, all of which is amortization, of course. So therefore, at the end of year 3, just before redemption, take the opening liability, 892.85, plus the amortized discount, 107.14, and our liability is increased to par value at, of course, the maturity date. Then at maturity, pay out $1,000, eliminate the liability, no gain or loss in the income statement on derecognition, of course. So notice the total of our interest expense is just simply the discount compared to par. So $1,000, we received $711.78. So the total, of course, 288.22. That's our discount, and that of course is the total of the interest expense spread over the 3 years. I know we've got a small rounding difference in there of essentially a cent. Now, again, notice what's happening to the interest expense. The same as when we issued a bond with a coupon that was lower than the market rate. In other words, what we're seeing is the liability is climbing over time, and you can see over the 3 years the liability value starting off with 711, then 797, then finally 893. It's getting bigger each year, and therefore the interest expense is increasing over the life of the bond. Now let's turn our attention to a bond issued at a premium. Now this time it's going to be the flip side. So far our amortization has been increasing the balance sheet liability over its life. It's been increasing the interest expense. Now with a bond issued at premium, it's just going to be the reverse of this. So initially the bond is going to be recorded at the proceeds, and then essentially we're going to reduce this liability down to par value over the bond. So the amortization is working the other way around. It's going to essentially reduce the liability value, but it's also going to mean that the interest expense is lower than the coupon. Let's take a look at our example. Illiquid Corporation issues a 3-year $1,000 par value bond. It's got an annual coupon of 20%, and it's issued at a premium of $1,130.88. So the premium $130.88. Now notice the market interest rate when this bond is issued is 14.33. So again, no surprise, it's trading, of course, when it's issued at a premium, coupon greater than effective interest rate, while a bond will trade at a premium, of course. Now, again, we receive $1,130.88. Up goes our cash by this amount, and of course, we create our liabilities. So assets and liabilities both increasing by $1,130.88. The interest expense, exactly the same calculation as normal. Take the opening liability times the effective interest rate when the bond is issued. In this case, 14.33. So 1130 spot 88 times 0.1433, and that gives us our interest expense of $162.06. Now let's compare that to the coupon. 20% coupon, of course, here. So 20% of par value, 20% of $1,000, $200. So again, notice very clearly that this time the interest expense is lower than the coupon, because this time our amortization is doing the opposite. It's reducing the liability and it's reducing the interest expense. So again, quick mantra to say to yourself: bonds issued at a discount, the amortization increases liability, increases the interest expense. Bonds issued at a premium, then of course the amortization reduces the liability, reduces the interest expense. Again, we can look at the amortization as being the difference between the interest expense and the coupon. So in this case, we've got minus $37.94. So the liability at the end of the first year, start at the beginning, second year, 1130.88 minus 37.94. The liability falls to 1,092.94. 14.33% of this gives us our interest expense of 156.62. Now again, when we look at the interest expense, notice our interest expense is decreasing each year. Year 1, 162.06. Year 2, 156.62. Whereas when we issued a bond at a discount, the opposite was true. Our interest expense was increasing as the liability grew, as it increased towards par value. Here, of course, our liability is decreasing towards par value, and therefore the interest expense is getting smaller. Year 2's amortization, the difference between 156.62 and 200. So this time we've got a negative amortization of 43.38. That reduces the liability by a further 43.38. So at the end of year 2, beginning of year 3, our liability is now $1,049.56. 14.33% of this gives us year 3's interest expense of $150.40. Again, compare that to the coupon of $200 to get your amortization, 49.60. Hey, look, we've got a 4-cent rounding difference, largely due to rounding differences in our interest expenses, our liability, and our effective rate. Okay, so again, the 49.60, when we add that amortization to the liability now climbs, of course, to par value. So again, when the bond is redeemed, no gain, no loss. Essentially, we pay out cash of 1,000, we eliminate a liability of 1,000, no impact on the income statement, of course, because proceeds and carrying value are identical. Okay, here's the same using a straight line approach. So again, all this is doing is looking at the premium, 130.88, spreading it over the life of the bond, 3 years. So 130.88 divided by 3, and that gives us amortization of 43.63 each year. So again, remember what we're going to do is to get the interest expense. So to get our interest expense, we're going to take, of course, the coupon, 200 minus 43.63 each period. So that's our interest expense of 156.37. And of course, we're going to be subtracting 43.63 from the liability each period. Again, we've had to use 43.62 due to rounding differences to get our liability to end up at $1,000. So that's our straight line approach as allowed by US GAAP. Issuance costs, so legal fees, the costs of prospectuses, commissions, printing, etc. US GAAP, IFRS take a different approach here. IFRS deducts it from the initial bond liability. So now remember, what that's going to result in is a higher effective interest rate. Why a higher effective interest rate? Because it was the internal rate of return between the cash you received and the future cash flows you were going to pay on the bond. And what we've just done essentially is reduce the cash you received. It's now essentially proceeds that you received less issuance cost. Issuance, there we go, cost, compared to the future cash flows on the bond. So essentially, by making this smaller, by making the initial inflow smaller by the issuance cost, you're going to make the IRR bigger. So you're going to have a higher effective interest rate. Okay, now that's how IFRS deals with it. What about US GAAP? US GAAP takes the issuance costs and shows them as a prepaid expense, i.e. an asset. Now this is very controversial because here, remember our definition of an asset. An asset was essentially something that was going to lead to a future inflow of benefit. Here, you've incurred the issue costs, you've issued a bond, you've incurred them in the past. Where's the future inflow of benefits? Not really meeting the definition of an asset here. Now, what we're going to do, so be aware it's a bit controversial, okay, because we're recording an asset, but there are no future economic benefits flowing from this asset. What we're then going to do is amortize the asset over the bond's life. So the asset's going to get smaller as the bond ages in the balance sheet, and the other side it's going to appear as amortization in our income statement. Okay, effect of changing interest rates. Well, again, the idea here is we don't really have any impact in the financial statements when yields in the marketplace, and by when they say interest rates, of course, we're really saying yields. When yields change in the marketplace and therefore market value fluctuates, it doesn't affect the financial statements. Of course, as yields vary over time, yield will affect the bond's value. Of course, future cash flows discounted at the yield gives us the bond price. So market value is going to fluctuate, but of course it's key that when we look at the liability, we realize we're not seeing market value. What we're seeing is a figure known as amortized cost. Okay, which of course is the original issuance proceeds plus the amortization of any discount minus the amortization of any premium. So, once the debt is issued, firms report the book value, not the market value. And remember, the book value is amortized cost. That's the approach we refer. So changes in interest rates, whilst they affect the market value, they do not affect the balance sheet value. Changes in interest rates, of course, and changes in yield affecting market value are going to be an issue for the investor, but they don't affect the company. The company is only really interested in the cash it raised when it issued the bond. So there's our issue. As interest rates change over time, it means the book value of our liabilities will no longer equal the fair value. Now, of course, there is an argument that maybe we want to see fair value, because the fair value would be the cost of the company of going into the market and buying its bond back early in order to retire it. Okay, so notice that's what we're really saying on this slide. Market value is more relevant than book value, because market value would be the cost to enter the market and retire your bond prior to its maturity date. So the cost of buying back the bond and cancelling it. So a lower market value means it's cheaper for the company to buy back its bonds, and therefore it's got a stronger solvency position. What causes market value to fall? Well, of course, interest rates, yields in the marketplace to rise. Notice both IFRS and US GAAP do allow companies to report debt at fair value. But if you do it, notice it's a one-off choice. Once you've chosen, then you've chosen for life. Okay. What about debt extinguishment? We're asked to explain derecognition of debt. It's rather like derecognition of assets. Now remember, when we derecognized an asset, we looked at the proceeds received, of course, compared to the carrying value. Carrying value being balance sheet value, and that gave us a gain or a loss that was going to appear essentially in our income statement. Now essentially it's going to be very, very similar when we look at bonds being retired early. Now, only difference here, of course, is if the proceeds, rather than proceeds being an inflow, when we look, which they are, of course, when we look at asset disposals, when we're looking at retiring our debt, we're essentially buying our bonds back early. So, of course, it's an outflow. So what we're going to find is we're going to get a gain recorded in the income statement if the purchase price is lower than the carrying value. So if the proceeds are less than the carrying value, what it's saying is we are paying less than the balance sheet liability in order to retire it. So we get a gain. We're going to get a loss if the opposite is true. If the proceeds that we have to pay to retire the bond are greater than the carrying value of the liability, then essentially we've got a loss. So if you pay less than the carrying value of the liability, you're going to get a gain. And if you pay more than the carrying value of the liability, well, I'm afraid you're going to make a loss. Now, typically, gains and losses on debt extinguishment, often they're included in continuing operations, of course, if they are normal part of the firm's business operations. So they might be included in income from continuing operations. Of course, if it is very, very rare, unusual or infrequent, we may see it in that area of the financial statements as well. Now, when you extinguish a bond under US GAAP, of course, remember, you may have had that prepaid expense asset, which represented the issuance cost, still to be amortized. Now, of course, if you retire the debt early, you buy back the bond early, you need to eliminate that asset. So any unamortized issuance costs, of course, are going to reduce the gain or increase the size of the loss. Again, when we look at debt extinguishment, we'd need to find a discussion of why the firm is buying bonds back early, so why is it changing its capital structure in the management discussion and analysis, but also detailed disclosure in the footnotes as well. Covenants. Describe the role of covenants here. Now, of course, covenants are placed on bonds by essentially by the lender. So placed on a borrower to protect the lender, of course. Okay, so we're trying to improve, if you like, the creditworthiness of this particular bond. Now, if we violate a covenant, then we're deemed to be in technical default. So it's not an actual default, it's a technical default. This might mean, at the most extreme, the lender can actually demand full repayment, or maybe at a lesser extreme, they can renegotiate the terms. So in other words, they'll probably require a higher coupon payment, something like that, higher interest payments. Now be aware, two types, affirmative covenants and negative covenants. An affirmative covenant means the borrower, the company, in other words, that issued the debt, will do something. So they're agreeing to do something. Will make timely payments of interest and principal, maintain certain ratios above certain values, maintain any collateral. So again, if the bond is secured on any collateral, the assets of the company, they may need to maintain the standard of those assets, pay taxes on time. Negative covenants are all about preventing a company from doing something. So refraining from doing something. Refraining from paying dividends. Well, again, as a bondholder, we don't like dividends. We'd prefer the company sits on its cash to meet future interest and principal payments rather than distributing to shareholders. Same with repurchasing shares. This is giving shares, of course, out or giving cash flows to the shareholders. Again, we would prefer the company sits on its cash to meet future interest and principal payments. Mergers and acquisitions. Well, of course, on an M&A, you might get a complete change in the capital structure, lots of changes in debt and equity. So again, often these are restricted or at least require bondholder approval if there's going to be a fundamental change to capital structure. And of course, issuing more debt. Typically, a lot of bond covenants will say more debt cannot be issued that ranks higher in a liquidation. In other words, we may well let more debt be issued that is subordinated to our debt, but certainly not that ranks higher than our debt. So again, a few examples of covenants. Affirmative, the company will do something. Negative, the company will refrain from doing something. So our learning outcomes move on to talk about the disclosures of long-term debt. Now, in the balance sheet, we're going to need to split our debt instruments between current and long-term liabilities. So a current liability, really a liability falling due for payment within the next 12 months, by the next balance sheet date. In other words, a long-term liability, anything falling due after this. Now notice what they're going to disclose in the footnotes, the nature of the liability, the type of the bond, so a description, what is the bond, what is its coupon rate, its face value, etc. Is it semi-annual, is it annual, does it have any embedded features like call or put features, conversion features, etc. So a description of the bonds. Now, very critical of course for the analyst, the maturity dates. We need to know the maturity dates because of course face value is going to be paid back here, being large cash outflows of the company. So we're very, very interested in when those maturity dates are, and in particular, is it likely that the company is going to be able to generate the cash to pay down its debt. Notice stated and effective interest rates. The stated rate is the coupon rate. The effective interest rate, remember, is just the yield or the internal rate of return when that bond is issued. Call provisions. Call provisions give the company the right to buy back a bond prior to maturity at a predetermined price. Normally it's at a premium to par value. The closer you get to maturity, the lower that call price becomes typically. Conversion provisions, well, we're talking about bonds that are convertible into equity typically here as well. Restrictions imposed by the creditors, well, those of course are our covenants that we mentioned on the previous slide. any assets that have been pledged as security. Now remember, if an asset's pledged as security, if the company fails to pay interest and principal, then essentially the firm can be liquidated and this asset can be used to pay down the bond on which it's secured. So assets pledged as security for bonds, and here's a very key one, the amount of debt maturing in each of the next 5 years. Again, going to be critical for assessing the firm's long-term solvency, the ability to meet these debt payments as they fall due. Of course, topical for companies, but also topical for countries, and we've been looking at Greece, of course, and the amount of its debt falling due recently.